Most business owners leave thousands of dollars on the table every year because of simple tax mistakes. They're either overpaying, missing crucial deductions, or worse, setting themselves up for an IRS audit. This happens because there's either a gap in your knowledge about taxes and how to leverage the tax code, keep more of your money, or you just don't pay enough attention to it throughout the year, causing you to scramble every April or deadline before tax day. In this video, I'm going to cover both of these areas based on the conversations I've had with hundreds of entrepreneurs who needed help with their tax strategy. And a quick disclaimer before we dive in. This presentation is for educational purposes only and not financial advice or tax advice. Always consult with your tax professional before implementing any strategies that we discuss. I'll break down exactly how to structure your business for tax efficiency, when to handle your taxes yourself versus hiring a pro, and the red flags that practically invite an audit. Even though tax season is behind us, or at least the early stages are, what I'm about to share will help you prepare strategically all year long. So business tax basics. So the first thing that I talk to people about is usually their structure. There's two different structures in a company. One is the legal structure. Most small businesses are LLCs, limited liability companies. That's going to protect your business from other interests that you have, personal or other businesses that hold their own LLCs. A lot of real estate is a big one that we talk about, where you might have a real estate building and then you manage that building. And we usually recommend from a legal perspective that you separate those two interests so that if something happens inside the building, the person will sue the manager, not be able to go after the building itself, who's owned by someone who's a third party, even if it's yourself. So an LLC separated from an LLC. And we want to understand income, self-employment, and sales taxes. Sales taxes is another form of tax. Some of our businesses are subject to sales tax, some of them are not, and some of us are half and half. So Rick, you're in the medical business. If you're providing medications, they're not subject to sales tax. But if you're providing certain other things, such as workout gear, then that is subject to sales tax. And so depending on where your environment is, it's just important to know so you don't get yourself in trouble with tax. And then we're going to want to track income and expenses year round. One of the biggest things I see, particularly in startups and people who are just sole owners doing the work and doing everything for themselves, is they're not keeping up with it throughout the year. So it's very hard to plan. You know, you could go ask someone for advice and say, hey, what do we need to do with this? But if they don't have a good scorecard to look at, they're not going to be able to provide you with very good advice. And then paying estimated quarterly taxes. I can pull up a schedule in a little bit. Once you're deemed to be responsible for filing quarterly taxes, then it becomes something that you're responsible to going forward unless something changes with your income levels. And so those are important pieces. So personal tax considerations. We'll move over to the personal side a little bit and how business income affects personal taxes. So most of us, how many of us are either what are called disregarded entities, where we just file our business on our personal taxes, or we're like an S corp or partnership? And so if you're an S corp or partnership, your profits, not how much money you extract from the company, will move to you and or your partners through a vehicle called a K-1. A K-1, I always like to tell people, is like a business owner's 1099. It's going to move over to your personal tax return. Your company, your S corporation, will not owe business income taxes. And fortunately, we're also in a state where not only will you not owe business taxes, but you won't owe income tax, personal income tax in the state of Texas either. However, one thing to consider is that your business may be subject to what's called franchise tax. Franchise tax is just a gross tax in the state of Texas. We're one of the most friendly tax states to be doing business in. But once you've reached over $2.4 million in revenue, the tax is on the gross, not the net. So even if you lose money, you could potentially owe franchise tax. I won't spend a whole lot of time on that, but make sure you're talking to your professional about that. Outside of that, on just a general sole proprietorship, also your money's going to then flow through and it's going to just show up on your personal tax return, usually in what's called a Schedule C, or if it's real estate, a Schedule E. And more or less what you'll see on there is what looks like a profit and loss statement on your schedule, and it just is kind of calculating the income and the outflow so that you can then pay taxes on the net added to any other incomes that you have. And so understanding deductions and credits. So there's two different things to consider. One is a tax deduction and one is a tax credit. Tax deductions really can just be called expenses. A lot of people misunderstand that a tax deduction is going to reduce your tax portion of the calculation. It actually just reduces your income before the calculation of tax, right? And so if we're able to write off travel, we took some business travel and we take a deduction, that's a tax deduction. It's really an income deduction. And when we reduce our income, then we multiply it by a tax rate. We've saved money on our taxes by doing that. And so as that goes, then there are tax credits, like the child tax credit, which you actually get a credit for taxes expenses for having children and having the expense of taking care of them. There are other things like investing in insurance. If you're self-employed, that will be a tax credit. Other credits could potentially be certain things like buying an electric vehicle, and where they'll give you tax credits for that. And those are actually reduction in your tax bill, not reductions in your income to calculate your taxes. And so those are important to understand the difference of. Retirement plans. One of the things I talk about a lot is less than 20% of small business owners in America have a retirement plan of any kind, other than the potential they might sell their business one day. And even that is, of course, subject to scrutiny. So we got to be careful about that. And retirement plans in a lot of cases can be tax deductible, and a lot of them can be extremely tax deductible. And so the limits on those are published. You can just Google limits for retirement plans for small business, and you'll see a few different plans out there. One of the popular ones for small business owners that do not have employees is what's called a SEP, and it's a self-employment retirement plan. And so it really works out in a great way because you can take up to 25% of your W-2 income that you pay yourself in your company, or up to, I think last year was $70,000 in deductible monies. A lot of times people are getting a little bit, they're on the younger side, so they don't necessarily want to tie it up in a bona fide retirement plan that they can't touch till they're 59 and a half. However, if your income levels are high and you don't have a lot of deductions, it's certainly something to consider, and then making sure that you're putting things into a plan that you have the opportunity to use as an investment tool is something to talk about as well. And so one of the cool parts about things like SEP IRA or even a traditional IRA where the limits are much lower, the traditional IRA you can write off up to $7,000 or $8,000 if you're over 50 years old. But in the future, once you have those plans structured, you can move those plans into other plans like a self-directed IRA. A self-directed IRA lets you invest in things like real estate or other businesses and things like that, so that you can take the money, put it into something that you would typically use as a vehicle just for retirement, and move it into an investment vehicle that's tax sheltered. And so those are things that are important to understand. They're a little bit complicated, so this is definitely where I would consider you getting some support and help. Another small business plan that's pretty common, particularly when you do have W-2 employees, is a 401k. 401k, just so people know, that is literally the tax code. It's the code 401-K in the tax retirement section of the tax code. And what that does is it gives you the ability to add more money. There's some unique components to that, such as profit sharing plans, which give you the ability as a business owner to up your deductible amount put into there to over $70,000, which is pretty substantial. And again, when you're getting a little bit older like I am, you start considering those things as better investments because you're able to move them a little bit sooner than later. It's also when you hit, you start hitting peaks of income and you just, either if you're not investing or don't have a clear strategy, these are good tax sheltered environments to be using. And then when you're going to extract them, you'll pay tax later at lower income rates. And so typically they're going to be beneficial for you. Now, some of you have heard of the Roth IRA. The benefit of the Roth IRA is that it grows tax free. And so if I put $5,000 in it today and it grew to $1 million, I pay no taxes on the additional $995,000 that I made. However, I get no tax benefit when I put it in. So that's post-tax dollars. And so that's one of the things. It's also the limit on that is pretty low, $6,500. And once you get over a certain income, you don't qualify to participate in it, but it is a great design. As we go through, one of the other deductions to talk about when you consider tax considerations is paying your children. So for those of you who have children, a great deduction is paying your children. One of the great benefits of paying your children is that you don't have to give them the money. They can use the money to fund things like soccer or like private school or lessons and those kind of things. I always tell people that if you really want to learn how to use your kids' money in a proper way, Britney Spears' dad has a whole lot of information on that and how you can, do that. Then your kids will get t-shirts when they get older that say save the child name, whatever, go from there. But ultimately, it really is a great strategy for you to use. Another great thing is if you're in a position to do it, when you pay your children up to the limit of the personal deduction, which in 2025 is going to be $15,000, you could pay a child $15,000. They will now have earned income. They can take some of that earned income and invest in a Roth IRA. It is truly a double tax-free environment because they've earned income, they qualify. They're not going to pay taxes because they're under the personal deduction limit. And like typical children, if you start this when they're young, 10, 12 years old, at an age when they could actually earn some income doing things for you, then certainly there's the great ability, because when you compound a Roth IRA for 50 years, you can imagine what $5,000 or $10,000 can do. While we're getting close to the end, I'll throw a little bit of math in one of my financial calculators and just show you what $10,000 invested for a 10-year-old would do over the next 50 years in time in just a typical index market. And it's pretty powerful because if you do that a couple times, you're really going to set your next generation up for great success if you can afford to do that. So it's really a good opportunity for you. Paying children does have some stipulations to it. They're supposed to earn the money. And so if they're 2 years old and they can't necessarily earn money, now that could be a little bit of a challenge unless maybe you own a business like Matt's business, where you can actually pay them a rate to be a model or a child actor or a social media star or things like that. Matt doesn't have any 2-year-olds left, but certainly an opportunity in how you can pay younger children to do things for you. Insurance is actually another business where you could feature them if you're willing to in ad campaigns and things like that. And we just tell people, Google the fair market value rate for a child actor or model in the city of Houston, Texas, and we'll come up with about $1,500 a day that you could pay that person. And so if they just did 10 sittings for you, then certainly you could pay them $15,000 legitimately.
If my wife was sitting here, she would ask you about our 2 dogs. We don't have kids. We have 2 dogs, Trip and Dixie. So
yes, unfortunately, dogs can't do tax returns, and so therefore, you know what? But if they are part of the security system, we'll talk about that. Right. We'll get you that garage where they're kind of chained up outside. What kind of dogs are they? Chihuahuas or Labs? Okay, Labs are big enough, right? Yeah. Although Chihuahuas are much more protective.
David, wouldn't that qualify? Let's say you could put a subset under advertising expense where you would pay for the cost if you were to use, a dog in the ad.
For sure.
Then you can do it there.
Absolutely. And we just always say, again, it's not hard to find the information on what they call fair market value. The thing the IRS would say, hey, that's not cool, is if you paid your child $15,000 a day and they're not some YouTube star who's making that kind of money, but they just, they always say to go to fair market value. So if you did use your dog once or twice in an ad, then you could probably do a write-off to advertising expense, but there's no place to send the money. Dogs don't have a tax return to do the deduction on. So it's, you're paying it, but you're paying it to yourself. So it's just money from left pocket to right pocket. So you have expense here, but then you have income there because as the owner of the dog, you would get that. So not a bad question though. So you could pay for the food for the day and those kind of things as you kind of go through. So certainly some option there. So the last component of really kind of getting ready for taxes, tracking owner's draws and then beginning to plan for estimates. So when you own an S corporation or any other type of partnership or even a sole proprietorship, you can just extract money from your bank account in your business and you can put it into your personal bank account. And those are called draws, owner draws. The biggest misconception on that is that the owner draw is taxable. And the owner draw is not taxable, but the income or profit of your company is taxable. 2 quick scenarios. One would be the simple one. You bring in $100,000 of income or profit to your company, but you only take out $50,000. The unfortunate part today is that you'll pay tax on $100,000, not 50, even though you only took 50 out. The good news is that when you sell or close your company in the future or extract that $50,000 in the future, that's yours to take at any time and you will not pay taxes on the remaining amount you left in the company. So that's important to know. On the flip side, you get a loan to start your company for $1 million. Your company profits $50,000, but you take $100,000 out. One of the scenarios where you say, well, how could I take out more than I profit? Well, if you have lending in there, you can. The problem with that is if you haven't built up profits over time, then you'll end up paying capital gains tax because you'll have taken out more than your company has in value. And so we've got to watch that. You can certainly change that into a loan to the owner and dilute it through future distributions, but it's something to be paying attention to or making sure that your tax professional is. Sometimes I've seen people prepare a tax return and then the client's like, well, why do I owe money? I lost money this year. And said, well, you took too much out of your company. And so the IRS wants to check on that and see what we can do. And then the last part is to plan for estimated taxes. So this is what I opened with. One of the biggest problems with tax and business today is that we don't look at it till it's too late to do things about it. And so throughout the year, when you're starting to look at your profit and loss statement, when you're starting to see your income come in, maybe your bank account's starting to grow, that's the time to start talking to your tax professional, asking some questions on what can I do to minimize my tax burden. The only time I highly recommend you pay really close attention to the reduction of taxes and when you're really, most of us don't want to pay any if we can avoid it. But if we can't, the time that you're going to pay the most taxes is when you're ready to qualify for a mortgage. Since the mortgage mortgage crisis in 2008 and 9, the government actually wants you to prove that you can pay the mortgage. Kind of weird, but ultimately you have to, through the tax return, prove that, which means you paid taxes on that. And then, hey, it's kind of like, okay, if you say you've made $200,000, you have to prove that. And mortgage companies now require a form called a 4806T, which gives them access to your tax record. So they're going to go back 2 years, and on the form, you can dictate which years it's going to be, and typically it's the last 2 filed years, and they're going to look at your tax return. If you say you made $200,000, before the mortgage crisis, it'd be like, hey, mortgage guy Sean, shake hands. Yeah, I made 200, man. Here's my money. Look at my bank account. You're like, oh yeah, okay, you're good for it, Dave. And then they would write a mortgage, and that's what created the mortgage crisis, unqualified loans. And also, of course, that creates problems in the market for values and all sorts of other things. But if you are planning to buy a home within the next 2 years as a business owner, you might consider paying a little bit more in taxes so that you have a better rate and qualify, and then go back to normal practice. The IRS will never complain if you take less deductions. I promise. Protect yourself and plan ahead. Work with an accountant or tax advisor at some point in time, just to kind of give you an idea. When you get into business, it's a little different than just having a couple of W-2s. Today's technology with a couple W-2s, I recommend TurboTax or one of the platforms like it, if that's all you have is a couple W-2s. Once you get past that and you start to operate a business, just be cautious who you're dealing with. Interview them like we've talked about when we talk about hiring employees or contractors. Do you have the ability to provide me with information on how I can save money on taxes or deductions that I may have missed, or the opportunity to review? If they can't answer those questions favorably, move on to another tax provider. And also know this, you do not have to be a CPA to prepare taxes. You need to take about a 6-hour course online, and then you can become a bona fide tax preparer. And so most of the people who go through like the H&R Block program, things like that, hey, H&R Block is a great service, and most of them do a pretty good job and work hard, but they may or may not be educated in business, right? And so there's a few multi-unit tax environments out there, and some of them have great staff. But at the same time, we want to make sure we're asking questions if you're using a service like that. But even if you're using a CPA who's been in business for 20 years and has 1,000 clients, you still want to find out if they understand you and your needs. So make sure you're asking some good questions. And then keep business and personal finances separate. This is one of the biggest challenges in business. Many business owners live through their companies. And so as you're living through your company, you're extracting money, you're going out to dinner, you're paying some bills. Try and keep the business and the personal. You can take distributions, take them in bulk. So you take a $5,000 distribution so you can pay your mortgage and other things. Don't pay your house mortgage through your company if you can avoid it. And then set aside money monthly for taxes. I typically recommend some sort of an automation tool for that, where if you look at your profit and loss on a monthly basis, I usually recommend people put somewhere between 20 and 25% away into an interest-bearing account for taxes. The best part is most of them don't ever owe that much money, because throughout the year we're able to take additional deductions or do some strategy for them, and then it feels just like it did when you were not in business for yourself and you were getting a W-2. You have this bank account, you pay your tax bill, and there's money left over. That's your business tax refund. This is one of those areas where I talk about why 75 to 80% of small businesses go out of business in America, and it's because they run out of cash. And one of the reasons they run out of cash is they get a $50,000 tax bill they weren't expecting, and they got $8,000 in the bank, and they make a payment plan with the IRS, and then they make the same mistake the next year. They're making good money, they get another huge bill, and they say, forget it. I can't keep up with this anymore. Keep up with it. You're now informed, so put a little bit of money away. Again, I recommend somewhere between 20 and 25% unless you're earning a lot of money, in which case then put a little bit more money away. So keep, use, schedule, and automate. Keep learning and updating. Like, just get a little information. The tax code for small business owners doesn't change that much. Things that change are retirement plans, things like that. Limits go up and down. The personal deduction changes every year. So last year was $14,800. This year it's $15,000. So when we're paying our kids, that might be something to know. All of it's easy to Google, but even better to ask your tax preparer. They're going to fill out that column inside your tax. Use accounting tools and tax software. So again, if you're doing enough business, at least use an accounting platform like QuickBooks or something like that to keep up with what's going on. All right, the last two pieces, schedule annual tax planning meetings. Now again, if you're not making a whole lot of money, these kind of things don't matter that much. But when you're making over 50, 60 grand profit a year, 100 grand profit a year, pay attention to it, because this can get out of hand really fast. When I first started the firm, I was shocked by how many people came to me with 3 to 5 years worth of taxes they hadn't filed yet. And what happens is they miss the first year. And then they get behind and they're going to catch up to it. And then they're afraid. And there's nothing to be afraid of. It's really just a matter of just get it done. Interestingly enough, you have a lower risk of getting audited if you don't file than if you do, unless you have substantial amounts of money being recorded that was paid to you, such as a huge 1099, which is why entertainers, I'm working with an MMA fighter right now. He got this huge 2 checks a year. The checks were worth $2.9 million on a 1099. The IRS knows he got that because the 1099 was filed to the IRS from the person who paid it. And so if it's $20, not gonna track that down. But interestingly enough, it is amazing how few audits we see for people who have not filed taxes. So again, unless they have substantial income written against them. Automate tax savings. Like I said, plan to just put some of this money away and not be surprised by it. It's coming. Man, the tax deadline is April the 15th. It's gonna be this year, next year, and every year after that, unless it's a Saturday or Sunday, in which case it's really right the next day after that, So it's the same time frame every year. If you plan for it, just put some money away. I always remind people this: your business and you are one unit. You're working in your business so you can satisfy the needs and wants in your household. And so if you're not focused on your cash plan at your house, then you don't know what you need to take out of the company and what you're going to do. And so let's plan those things and be conscious of it so we can be the best stewards. Another thing on vehicles is mileage or expenses. It's not both. So if you're paying for, I always recommend people pay for everything in their business, pay for the fuel, pay for the tires, pay for the oil changes, and track miles. Take whichever is the best. I hope you found these tax strategies valuable. If this information helped you think differently about your business tax approach, please give this video a thumbs up and subscribe to the channel. If you want to dive deeper into these strategies and learn more ways to grow your business, I recommend you check out the mini course in the description of this video. We cover everything from advanced tax planning to business budgeting and financial forecasting, all designed to help you keep more of what you earned and scale your business faster. That said, I'll see you in the next video.